Welcome back, everyone, to another episode on Living Your Greatness. I am your host, Ben Mumme. And if you are new to my show, I encourage you to smash that subscribe button. Today, I am joined again by Rick Rule, a highly experienced investor and speculator from Rule Investment Media. So, Rick, it is a pleasure to have you back on the show.
It's always my pleasure. Thank you for having me back.
Good to have you back for sure. Rick, I kind of want to focus with today's conversation on something a little bit different. I really want to ask you questions related to the greatest investors in history and taking some of those timeless insights and investing principles and discussing how you've applied that to your personal investing career. So the first investing principle, Rick, that I want to kind of bring up here is I think it's really important for investors to be patient as well as think of long-term thinking. So a famous quote actually from Charlie Munger, who actually recently passed away, a true great, is, he famously said, waiting helps you as an investor. And a lot of people who just can't stand to wait. If you didn't get the deferred gratification gene, you've got to work very hard to overcome that. So Rick, what I'm trying to get at with this quote is, in resource investing, where patience is often crucial, how do you personally cultivate and maintain the discipline to wait for the right opportunities, especially in the face of market fluctuations?
I've been in the game for 50 years. And what I've learned over 50 years is that my time preferences don't matter at all. When I was a young man, ironically, when I had more time on earth, I was less patient. I'm not more patient as a consequence of the fact that I have less time on earth. I'm patient because I've observed what it takes over 50 years. Making money is all about compounding. And you can't compound in a short period of time. I'm not just talking about compound interest. In the exploration business, some value is created by a drill hole, but real value is created by 300 drill holes. Each drill hole capitalizing on the knowledge learned from the drill hole behind it. I've had the good fortune in my life, Van, to participate in literally dozens of 10-baggers about the most fun that one can have in financial life. But contrary to popular opinion, none of them occurred over 3 months. The average time, the average duration required in a 10-bagger or a 20-bagger or a 30-bagger is 5 years or 6 years. To the extent that somebody harvests a 25 or 30 or 50% gain after a few good drill holes, they may be costing themselves 900% or 1,300%. Whether we like it or not, time is the requirement of building wealth.
Yeah, no, absolutely. And I think it's interesting or important to always bring up because I feel, I don't know, like maybe I'm just speaking on behalf of what I'm seeing, but there definitely are a lot of investors when we think of on Twitter, for example, that are really impatient and really thinking like the short-term game.
I regard the people who think that their time preference is relevant as being cannon fodder. The only thing they add to the market is liquidity. I regard people who have the fear of missing out too. The people who are tempted into hot stories that they don't understand. These people are normal and natural victims, and I'm afraid for a few winners, there have to be a lot of losers. I prefer to cast myself on the side of a winner rather than on the side of a loser. As a consequence of that, I'm patient and I'm disciplined.
Absolutely. And those are some key ingredients. So another, principle I want to move to is I think it's, important to discuss also ignoring short-term forecasts, and so, Warren Buffett famously said, I make no attempt to forecast the market. My efforts are devoted to finding undervalued securities. So, Rick, how do you approach the challenge of avoiding short-term market predictions in the resource sector? And how has this philosophy contributed to your success?
Some of your audience will have to forgive the next quote. Very politically incorrect. I've discovered I only have 2 balls. Neither of them are crystal. I have no ability to make short-term forecasts, nor does anybody else I know. I make some long-term forecasts if a commodity is priced on the global market less than the cost of production, and it's a commodity that's necessary for the material well-being of humankind, I know that the price will go up or else the commodity won't become available. But that's not the same as a short-term forecast. Buffett said more than the quote that he gave you. He said trying to forecast markets themselves, financial markets, was a waste of time. He says you could devote 15 or 20 minutes a year to it for your own amusement, but anything longer than that was a waste of time, and time is in fact money. He said it's trying to know the unknowable or comprehend the incomprehensible. Amusing on occasion, but a waste of time all the time.
Well, Rick, it shows that you know Buffett's quotes really well. So a third kind of principle that I want to move to now is to actually discuss with you in terms of not trying to time the market, and when we think of Peter Lynch, he famously said, far more money has been lost by investors trying to anticipate corrections than lost in corrections themselves. So Rick, given the volatility in the resource markets, how do you navigate the temptation to time the market and instead focus on the long-term potential of your investments?
Well, I guess it gets around to your definition of timing the market. I would suggest that I do time the market. I participated in the uranium business in 2022 when nobody else does, in anticipation of the fact, or 2021, in anticipation of the fact that in 2 or 3 years, a commodity will go from hated to not hated. The easiest arbitrage in the natural resource business. So I think I do time the market. It's just that I time it in 2-year or 5-year or 7-year sequences. I don't try to time it in weekly or daily or monthly circumstances. And I think in that regard, Buffett timed the market too. When Buffett would find an extraordinarily high quality business at a fair price, this often occurred during market routes like 2009, he would forget about the so-called state of the market. He would forget about the narrative of the masses. And he would look at the juxtaposition between the price of the investment and the value of investment. In a very broad sense, that's market timing. You only get bargains when all of your competition is either bored or scared. That is market timing. It's just market timing with a decade-long duration. I would argue that Buffett's move into Chevron and Occidental in 2021, 2022, when the oil price was depressed due to COVID, could be described as market timing. Buffett looked at the fact that the market was ignoring one of the best businesses in humankind, which is to say the oil and gas business, and that the price of oil was temporarily at $20 a barrel on its way to above 60. And so he threw, several $billion at the space. That could be described as market timing. He didn't worry particularly whether he paid $20 or $22 a share for a company that was worth 80. And he didn't worry too much about capturing the intraday low. What he worried about was buying $80 bills for $20.
That's another great example. So Rick, another one that I want to kind of move to is, a fourth investing principle that I think is key for investors to be aware of is like markets fluctuate, and the importance of staying like the course, right? Yep. So, Benjamin Graham, who I know you really like, famously said, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. So Rick, how do you stay the course during short-term market fluctuations in the resource sector, keeping your focus on the long-term value?
Well, that's my favorite of all financial quotes, by the way. Given that I'm consistently disparaging of the way people vote, I just think that's an absolutely wonderful quote. Listen, again, as a speculator, and I suspect that your audience is mostly young and hence drawn to speculation. As a speculator, which is to say for me, taking risks in search of 10 baggers or 20 baggers, staying the course is critically important, in addition to the fact that almost every 10 bagger I've ever enjoyed, and certainly every 20 bagger I've ever enjoyed, has required 4 years or 5 years or 6 years. Every one of them that I can remember has required me to endure a 50% share price decline during the period of time that I owned it. That's difficult to do. If you have a position that's down 50%, you do not have a hold. You have a buy or a sell. If you believe that you're right and the market's wrong, you owe it to yourself, given the time that you've invested in the idea, to add to your position. If you're wrong, you owe it to your portfolio to admit defeat and sell. So it's important that you have the courage of your convictions and that you continue to update your valuation work and your consideration of the delta between price and value. Having the willingness, in fact, the eagerness, if a share falls in price but not in value, to add to your position. Buffett has a couple of great quotes around this that you should add to your repertoire. And I'm going to paraphrase them because I can't remember them directly. Buffett said that you shouldn't buy one share of a company where you wouldn't be willing to buy the whole company if you were able to at the same price. Nor should you buy a share in a company where you wouldn't be perfectly comfortable seeing the market cease to exist for 5 years before reappearing, because you believe that your share of the value of the business would increase enough over 5 years that you would be compensated for illiquidity. Now, those are both sort of ephemeral quotes, but let me give you the next one, which will scare the hell out of most of your listeners. You shouldn't be willing to buy a share of stock if you hadn't done enough work understanding the valuation that you wouldn't be delighted to see it fall 30% the month after you bought it, so that you could employ the same intellectual capital over physical capital. Now, frankly, I've been tested with that thesis a few times. It isn't pleasant, but the information imparted is always correct. Usually now, as a speculator, not so much as an investor, but as a speculator, I'm actually hoping the stock goes down. If I buy a speculation, I'm buying a speculation for 100% gain or a 200% gain or 1,000% gain. What that means is that in the month after I buy a stock, if it goes up 30%, I likely won't do anything. But if it goes down 30%, I'll likely buy more. So ironically, I'm now of a position where I limit my speculations to the extent that my preference in the near term is if the stock falls, so I can add to my position. That is something that's taken me 50 years to learn. That was not my preference when I was in my 20s.
And that actually, ties into the next investment principle that I was going to bring up, which is, when we think of market correction as an opportunity, Benjamin Graham famously said, the intelligent investor is a realist who sells to optimists and buys from pessimists. And I know you're huge on this. And so the reason why I'm bringing that up is, can you share an example when you took advantage, something that was completely unloved, undervalued, and then, took advantage of this opportunity to buy more?
Well, my very best example was Paladin Uranium. If we go back to 1998, 1999, nobody cared about uranium. It hadn't moved for 20 years. That's a long bear market. And in addition to the fact that people were bored by it, people hated it. If you talk to people, as I did, about speculating in uranium, people became actually hostile. They would accuse you of profiteering from Chernobyl and Nagasaki and 3 Mile Island. There's nothing that a contrarian likes more than being hated. We're a perverse bunch. So it began to be clear to me in 1998 that uranium was selling for $8 a pound while it cost $30 a pound to produce. In other words, the industry was in liquidation. It was also obvious to me that 20% of baseload power in the developed world came from uranium. So either the price went up or the lights go out. Those were the two choices. There were no other choices. And I began looking around for ways to express my fondness for uranium. I was at a then very small conference in Western Australia called Diggers and Dealers in Kalgoorlie, a different story, which maybe we'll get to some other time. And I came across a little tiny uranium company, Paladin Uranium, 1.8 million Australian market cap, 1.4 million US market cap, headed by a very odd genius named John Borshoff. And I asked John Borshoff, I said, John, with $1.8 million market cap, how can you afford to explore for uranium? You don't have any money. He said, I don't have to. I said, why is that? He said, because I ran worldwide exploration for some West German uranium companies, and I got as my parting gift, as my severance, their worldwide uranium database. So my database was funded by the West Germans at $1 billion. I don't have to explore. All I have to do is stake stuff that the West Germans discovered. That was the best answer I ever heard in my life. And so I led a financing, I think it was 20 million shares at a dime. So a $2 million financing on a 1.8 million market cap with a full warrant. And I can't tell you how happy I was about it. And the stock in the beginning went up. It went from 10 cents to 11 cents to 12 cents to 13 cents. Turns out it went up because there was no float, and I liked it. In other words, I was the cause of that stock going up. I didn't know that. Then the furor engendered by my love subsided, and the stock went from 13 cents to 11 cents to 10 cents to 9 cents to 8 cents to 7 cents. And I found myself having, with my clients, more than half of a company that had gone from the 10 cents where I financed it all the way down to a penny. Now, a 90% decline in 9 months, again, that's not a hold. That's a buy or a sell. So I had to re-examine my premise. And by the way, the uranium price hadn't gone anywhere at this point in time. And I looked through my thesis. I looked through what Borshoff had done with the $2 million we gave him. I said, you know what? The market's wrong. I'm right. I didn't manage to buy any at a penny because I procrastinated, thinking I might get it at 0.8 of a cent or some idiocy like that. But I was able to buy a reasonable amount of stock at $0.015 and more at 2.5. And I'm delighted to say that 6 years later, that stock was $10 bid. Oh, you know, a few things happened. John was able, with the money that we gave him and with the warrant exercise, to stake 3 big uranium deposits. And uranium went from being hated to being tolerated. And then from being tolerated to being loved. The uranium price itself went from $8 a pound to $140 a pound, which made deposits that were marginally economic at $30 or $40 a pound stupidly economic. But I think there's a whole bunch of lessons there. The lesson being that price action is less important than the delta between price and value. And if you don't have an opinion as to value, the price information is worthless. Who cares if something is a dime or a dollar if you don't know what it's worth?
Yeah, no, I appreciate that that explanation there, Rick. So the next investing principle I want to go to is actually from one of your greatest mentors, Peter Cundall. So he famously said, when a stock doubles, sell half, then what you have is a free position. Then it becomes more of an art form. When you sell, depends on individual circumstances. So essentially, you know, this quote is a lot on knowing when to sell. So a question that I have for you, Rick, is what are your thoughts about this quote from Peter Cundall? And, you know, how did it impact you on knowing when to hit the sell button?
I have to say, first of all, that Peter Cundall was the greatest influence on my investing career because I got to spend more time with him personally. So Peter was more important to me than all of the other investment mentors that I've ever enjoyed combined. And I would encourage people to look on YouTube for Peter Cundall speeches and play them repeatedly and learn. But he was wrong with that quote. I subscribed to it. Peter Cundall, like Ben Graham, was more focused on not losing money than he was on making money. And Peter would do wonderful work and cause me to do wonderful work. And then we would waste some of the benefit of that wonderful work we did by reflexive selling in order to avoid loss. What I've learned, particularly in exploration, is if the news changes, if the fundamentals change, your assessment of the value has to change. There have been 50 or 60 times in my career where a stock went from $1 to $3 and it was worth more. In other words, it was more undervalued at $3 than it had been at $1. And for a decade, I followed slavishly Peter's advice and Ben Graham's advice, which is to say that you minimize your downside. You can't minimize your downside if the logical conclusion on the arithmetic, the delta between value and price, argues to the upside. Now, in exploration stocks, in a bull market, we sometimes have a very different situation. We buy a stock because we believe that the answer to an unanswered question will lead to an increase in valuation. But the market price of the stock doubles before the information has changed, which is to say you get a free double. You absolutely, positively take those. If the price of something goes up, but the value hasn't changed, you owe it to your portfolio to harvest the stupidity of those around you.
Great answer, Rick. The next investing principle that I would like to talk about is, failure comes with territory, and this is big from Ray Dalio. So he famously said, if you're not failing, you're not pushing your limits. And if you're not pushing your limits, you're not maximizing your potential. So Rick, how do you approach risk taking? And can you share a situation where a calculated risk resulted in a valuable learning experience for you in resource investing?
I think it's important to say that depends on who you are. There are investors like Ben Graham who grew up in such dire circumstances in the Depression that his investment technique, which meant minimizing losses, buying companies that were nets that were cash flow positive, where there was no possibility of loss over time, was the correct methodology for him. He could not have done what some of the people he taught, like Warren Buffett, were able to do later, because his psychology was very different. So I don't believe that that's a one-size-fits-all criterion. I do believe that for speculators, you have to have a psyche that embraces risk and that understands that loss is part of the cost of victory. The best pure speculator that I know in the exploration and in precious metals is my former colleague, Eric Sprott. I say former because neither him nor I are any longer with Sprott. And I got to watch Eric up close and personal in the period 2011 to 2015, where the price, the ascribed value of his portfolio fell by 85%. And it didn't change any part of his character. Eric thought, I'm right. I was overly aggressive before. I'm paying the cost of that. What I need to do is not abandon the sector. It's just become much, much, much cheaper. I need to look at the companies that are left and segregate between the winners and losers for the rebounds. Eric is absolutely willing to take 100% loss on a position where he thinks that there's a 40 or 50% chance of 1,000% gain, because the arithmetic is that one winner amortizes 10 losers. Eric absolutely understands that loss, absolute loss, is the price of success. I think it's important to know in speculation that most of your decisions will lose you money. As a speculator, out of 10 starts, you may lose some money 7 times. But if you recover some of the money, if you admit defeat and limit your losses to 30% or 40%, and you participate in a 10-bagger, and you participate in a couple of doubles, what you find is that you end up with a 30 or 40% compound return on capital employed over a decade in your speculative activities. Now, doing that may extract such a large emotional cost from the speculator who can't stand loss, that they shouldn't be in speculation. When I was active in assisting people managing their portfolio, I had a very, very, very wealthy family office that I wouldn't allow to speculate, because the psychological toll that bad decisions took on them was such that it offset any money that they might ever make. They were sort of like Ben Grahams on steroids. They had made a lot of money over 5 generations in the real estate business by investing intelligently in property and letting time be on their side. And while they were attracted to the upside in what I did, attracted to me personally and attracted to my knowledge, the volatility and the absolute risk in exploration was such that there is no amount of money that they could have made that would have offset the disutility that they felt psychologically for participating in the process. If you can't take the pain, you won't get the gain as a speculator.
Yeah, no pain, no gain. And that's been said a lot. Rick, are there any investing principles, from either great investors or even rules that you've learned that maybe you've written down for yourself?
Invest in yourself first. Knowledge can't be stolen, it can be lost, and it can't be taxed. The fruit of knowledge can be taxed, but the knowledge itself can't be taxed. Invest in yourself. Read a book a week. Repeat, read a book a week. Increase your knowledge base. Increase the experience that you bring to the process of investing. Practice technique in investing. Think through investments. Do not own, as a speculator, more stocks than correspond with the hours per month you're willing to spend on your portfolio understanding the stocks. If you own 30 speculations, then allocate 30 hours a month to read quarterly reports, property statements, annual reports, proxies, insider filing statements. And by the way, listening to generalized Rick Rule interviews on YouTube doesn't count against the 30 hours. This has to be 30 specific hours around your portfolio. And outside those 30 hours, spend time learning how to analyze a portfolio. There are 200 hours of free instructional material at the Rule Classroom. Absolutely free. You get the value of 50 years of my life in investing lessons for free. Read that. Learn how to invest, learn how to analyze companies, and then apply that to companies in your own portfolio. Invest in yourself first. The second lesson is save. Most investors, it turns out, don't really want to be rich. They want to live rich. You can't ever become rich if you're not a capitalist, and you can't be a capitalist if you don't have capital. I learned when I was 16 years of age from a book written by a guy named Nickerson that you pay yourself first. You take 10% when you're poor of all of your pre-tax income and you save it before you do anything with it. You don't buy yourself a fancy pair of Nikes. You don't even buy yourself a Starbucks. You don't even pay tax. You pay yourself first, 10% pre-tax. If you need that money for something and you borrow it, you pay it back into the account. If you have to buy a car, okay, you have the cash to do it. But then in addition to paying 10% pre-tax, you have to pay yourself back principal and interest in your savings account before you move on. You can't be a capitalist without capital. And if you're not a capitalist, you cannot get rich.
I really appreciate those additional lessons there that you've shared, or principles, Rick. Another question that I want to kind of ask you is, there's a lot of things that you've said over the years, whether in speeches, interviews, where you've been very, very, very consistent. And so one of them that I want to actually talk about, in fact, I call them like Rick Rules, ruleisms, is some other rules that I've heard you say. And so one of them that I've heard you say before is, I confuse a bull market with brains. So what did you mean by that?
When I was a young man, obviously a long time ago, in the decade of the 70s, I mercifully was interested in natural resources. I came to understand as a very young man, 15 or 16, that sector had been out of favor for 20 years or 25 years, and I was interested in it. So I had the good fortune really to come into the early part of the decade of the 70s with a predisposition towards natural resources. And the 1970s was a ridiculous era for natural resources, a ridiculous bull market. The oil price went from $3 to $30, the natural gas price from 30 cents to uncontrolled deep gas, $15. The silver price from $1.50 to 50, the gold price from $35 to $850. And I made in the decade of the 70s a lot of money for a young man. Young male hubris meant that I thought the reason I made all this money was because I was a genius. I didn't take into account the fact that I had the wind in my sails. I confused a bull market with brains. In addition to that, because I had been right with the narrative when other people didn't have it, I clung to the narrative. I didn't understand that markets work. Towards the end of the decade of the 70s, when prices didn't have to go up anymore, all of the big thinkers extrapolated trends in motion and thought they would. So outfits like Chase Manhattan Bank, the International Energy Agency, the United Nations Development Bank, all of these people were forecasting that the oil price, having gone from $3 to $30, would continue to $100 or $200. There was a popular narrative driven by the Club of Rome that the world had run out of resources, that food prices were going to quadruple, that 40 million people a year were going to die of starvation. The big thinkers of the world didn't understand that markets worked. And because that narrative was useful to me, because it confirmed the biases that I had discovered to my delight by becoming rich, I clung to it. The consequence of that is that when the market turned and I didn't turn, I went from being a very, very wealthy young man, hubris-ridden to be sure, to being a somewhat more humble young man with a negative net worth, which is to say liabilities greater than assets. I'm delighted to say that I understand now that markets work, and I no longer confuse bull markets with brains. I still enjoy bull markets because I position myself in bear markets.
Great answer, Rick. And you know what? That actually makes me think of something that I want to share with you. Is I recently read Clear Thinking by Shane Parrish. And
Right.
one key takeaway is that success comes down to positioning. That proper positioning allows you to master your circumstances. So what does this mean for you as a resource investor? And how do you continue to position yourself to take advantage of the right opportunities?
Well, mercifully, I'm what you might say at the peak of my career now. I no longer have 230 employees to distract me from making money from my own account. But I have a wonderful, I would call them Rolodex, you would call them contacts. I have the ability to call anybody I want to in the industry and get a call back. If I don't know that person, I call somebody who does know that person who says, would you do me a favor and call Rick Rule? So I have access to wonderful information. In addition to that, I have 50 years of experience. That isn't to say I don't make mistakes all the time. I do. I'm a speculator. I assume mistakes. But the truth is, I've already positioned myself. Most importantly, though, Fan, and this is important, I have positioned that part of my experience, which is to the left of my right ear and to the right of my left ear, to take advantage of circumstances and think correctly. I'm no longer guilty of fear of missing out. I'm no longer guilty of short-termism. I'm no longer guilty of envy. I have a lot of capital, which helps, but I no longer need to have 100% of that capital employed in the vainglorious attempt for 20 to 1. I have a lot of capital by way of liquidity, so that if an illiquidity event occurs in the future, rather than being victimized by it, I'll be a beneficiary of it. I remember well 2009, after the 2008 collapse. Because I was psychologically prepared and financially prepared, 2009 was one of the best investment years of my life. That downturn was a gift from God. That's part of positioning. Positioning your portfolio, positioning your mind, having the balls to push the button, the buy button, when everybody else around you is pushing the sell button. That's important. I guess the last thing that has positioned me is my understanding really of what money is and how money is made. Money, I think, is a medium of exchange and a way of expressing your individual will. You do with your money, that money itself being the excess value that you created for society over the money that you consume. That's really what wealth is. If you generate more utility for others than you consume for yourself, you get paid in something called money, and that's a measurement of the utility that you created. Once I came to understand that what I had to focus on before I focused on becoming rich was focus on developing utility for others. creating more utilities for others than I consume for myself, I suddenly learned that wealth would take care of itself. Wealth was creating surplus utility. That's all it was. Managing wealth is different. But managing wealth really gets down to understanding how utility is created and speculating in the utility creation in things like companies. That's really what it's all about. When you begin to understand the process in those very simplistic terms, what is money? What is wealth? Then you begin to understand, first of all, how to make money from your own efforts, how to manage money, and how to create wealth for yourself by developing and delivering surplus utility to others. You learn, too, that becoming rich is philanthropic. People are going to hate me for saying this, but the very wealth that Bill Gates has made for himself, as an example, proves that he has already been philanthropic. He doesn't have to give money away, although he does. The value that he has generated building Microsoft and investing has meant that people have paid him willingly for those products. And he has generated more utility than he has consumed. Hence, he is wealthy. And hence, that very wealth is proof of his contribution to society. He needn't do more, although he does.
I really appreciate that explanation there, Rick. And, I know there's a lot more Rick Rule rules, that we could go through, but let's save that for a future conversation, to bring you back on the show. But Rick, I would like to take this last little bit of time, to talk about, you have an upcoming boot camp where you will continue to generate and give wealth of knowledge to other investors. And that's on January 6th. And I believe the topic will be on the development stage and pre-production stage in mining. So is there anything else that you wanted to add on the upcoming boot camp?
Yeah, I guess I want to say a couple things. What I do in my declining years is add utility through education. Rural Investment Media is all about investor education, as is the Rural Classroom. 4 times a year, we put on a boot camp where we take one theme of natural resource investing. We've done royalty and streaming, we've done silver, we've done uranium. Now we're doing development stage companies. And we spend 8.5 hours on them. We throw content at you. We teach you enough in 8 hours, 8.5 hours, that you can learn how to become a good investor in that segment. These boot camps are meant to be consumed in conjunction with the free lessons at the Rural Classroom. There's 200 hours of programming at the Rural Classroom. Take as much of this as you can stomach, and then attend the boot camp. Employ the lessons that we teach at the classroom at the boot camp. This costs you $99. If you don't feel like you got your money's worth, I will refund that $99. No questions asked. Why development stage companies? Because development stage companies right now are, in my opinion, undervalued relative to the valuations that they've enjoyed for the last 40 years. Development is regarded as the boring part of the Lassonde curve, where the news is no longer about discovery or about commodity prices, but rather about how much cement is poured and how much steel costs. And what that means is that it's a neglected part. People don't like to be bored. They like to be excited. But my experience has been that development stage companies, when they get through the Lassonde curve, when they deliver, if they do, on time, on budget completion, at nameplate capacity, uniformly double or better. Ironically, the lowest risk part of the value creation chain is the part where the discrepancies between price to value are often the greatest, at least with regards to risk. So I would urge any of your listeners who are natural resource investors or speculators to attend the development boot camp. The financial risk is mine. If they don't think they got their money's worth, I'll give them their money's back. But I don't want them to do it if they aren't prepared between now and then to visit the Rural Classroom and learn the lessons that will prepare them to absorb the value given at the boot camp. I would encourage them to understand that the 8.5 hours that they spend at the boot camp will be a down payment. We will give you more content in 8.5 hours than you can absorb in 8.5 hours. And so that content will be available to you for you to replay for a year. So don't attend the boot camp and then say, oh, I did my education, I'm done with it. Attend it, and then attend it, and then attend it. And use the lessons that you learned consciously in evaluating investments and maintaining your knowledge for the investments that you already have. If you aren't prepared to invest yourself, don't spend the money. Don't come to the boot camp. This is only for people who actually want to be successful and become rich and are willing to work.
Awesome, Rick. Well, I really appreciate you, giving more background. Just want to take this last little bit of time, to really, thank you for being here today. Thank you for coming back to, touch base with my audience and my listeners. And is there anything else that you would like to add before we sign off?
Well, finally, anybody who cares what I have to say about natural resources can find out in a personalized fashion. If you go to ruleinvestmentmedia.com, list your natural resource stocks, and I personally will rank them 1 to 10, 1 best, 10 worst. I'll comment on individual issues where I think my comments might have some value. Please, no crypto. Please, no pot stocks. Please, no tech stocks. Leave an old man to do what he does well. Ruleinvestmentmedia.com, list your natural resource stocks. And oh, by the way, one more thing. If you are, irrespective of your age, unhappy with your current bank, there's a new bank in organization, Battle Bank, battling for better banking. If you're unhappy with your current bank, when you are at Rule Investment Media, in the question and comments section, write bank. You will join 11,000 other people who are uncomfortable with their current banking relationships, who are thinking about becoming a depositor or a borrower from Battle Bank.
Awesome, Rick. So I will be sure, to add all those hyperlinks so people know where to go. And I just want to thank you one last time, Rick, for being here today.
Always a pleasure. Thank you for the opportunity. This is what gives an old man amusement.
Absolutely.